The economic data has gotten a little bit better, yet I still think when we put it all together, when we look at all of our indicators for recession, it seems that there is an increasing probability of recession before the 2020 election. Obviously, the yield curve being flat and even inverted from Fed funds, at least at this moment, out through the curve, that's clearly something that is a precursor of potential recession. What you hear a lot in financial media is after the curve inverts, and media likes to focus on the 2s-10 spread. I'm not sure why exactly, but it seems like when the 2-10 spread goes negative, even by a tiny amount in the U.S. Treasury market, you start to hear all these, is this a recession signal? But the way history kind of has proved to work is that when the curve inverts for the first time, and I really look at not 2s-10s, but we can look at that if you want. I look at the Fed funds rate out to the 10-year or the 30-year. What happens historically is the curve inverts well before a recession. And I've heard many guests on CNBC over the past several months point out this fact correctly, that the curve inverts well in advance of the front edge of the recession. But what people don't understand is that when the recession is getting to be close to your doorstep, the curve actually steepens out, because the Fed gets the joke finally that they're behind the curve and they need to cut interest rates more.
But we've mentioned that, right? If you get in a rate cut cycle, it could steepen. It would steepen the curve.
Sure, absolutely, and that's what's happened historically. And when the curve steepens out with the Fed cutting, a lot of people say, "Oh, this is a sigh of relief." It shows that the Fed's on the case and recession could be averted. But historically, that hasn't been true. What happens is once the curve starts steepening out, recession's getting closer and closer. The indicator for recession that to me is the most compelling in terms of watching and being concerned about is consumer sentiment, comparing how consumers in the United States feel about the present contrasted to how they feel about the future. What happens before recessions every time in a very convincing pattern is that first consumers start to feel bad about the future. They say the future looks worse than how I feel about the present. And that started quite a while ago now, where the view of the future was much grimmer than the view of today. That puts you on kind of a notice, just like the yield curve inverting, that maybe you're supposed to be on recession watch. But then what happens is the consumer continues to be pessimistic about the future, but then their attitudes about the present start to deteriorate. And that has started to happen, particularly in Europe, but also in the United States to a more minor but not insignificant degree. Consumers' view of the present is starting to deteriorate pretty rapidly, and their view of the future continues to be pretty grim. And this is really a very common sign of the consumer maybe being poised to pull back. We haven't really seen that yet so much.
No, we haven't.
But
The data again today suggests otherwise.
Yeah, that's right. But consumer spending, or consumer attitudes and consumer spending are notorious for being very strong right at the last minute before a recession. It's the consumer ideas about how things are going that collapse the last. So CEO confidence has started to deteriorate noticeably, with new orders really in a free fall. We've seen manufacturing not doing well. Industrial production came out higher than expected yesterday, but it still declined on a year-over-year basis because the number that rolled off from a year ago was even higher than last time. So there are some indications. I mean, the ISM manufacturing is below 50. That's not a good sign. So it's much more of a mixed bag. Some of the times when we've talked in the past, we talked about how there's really was no compelling case that a recession might come within the next 12 months. But now, even the New York Fed's model, which is incredibly simplistic, it just uses the shape of the yield curve, it has recession probabilities in the next 12 months about the same as the probabilities that preceded each of the 3 recessions of significance since 1985.